You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the Cboe over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for our monthly sojourn through the world of advisors and options. Yes, it is time once again for the Advisor's Option, the program for you, the busy financial advisor and asset manager. Maybe you're already using options with your clients and you want to learn more. Maybe you're considering dipping your toes into those options waters. Either way, we've got you covered here on the Advisor's Option. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which all of you folks are busy sucking down all of the bandwidth. Don't worry, there's more where that came from, so have at it out there. And of course, if you want more in your lives, and who doesn't, you want to come back for some awesome pro Q&A sessions, as well as options oddities to wrap up your week after Volatility Views, where we get into all the unusual activity and the trades that are lighting up our tape. In fact, our pal the Rock Lobster messaging me right now as we're kicking off the show, telling me some trades he's putting on. I can tell him I'm on the show right now. I can't talk to you. But there's a lot going on that program as well. If you want to check all that out, only one place to go. theoptionsinsider.com/pro is the place to go to learn more. As you learn who's joining us on the Advisor's Option today. First, let's go out to the shoreline. Yes, there is a shoreline. It's small, but it does exist. The shoreline of New Hampshire, where we are joined once again by Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the father of the rogue AI known as Otto. Mr. Matt, welcome back to the show. How goes Otto? Has he killed everyone yet?
Otto is taking over. I use Otto on a daily basis to ask questions about my own company. So yes, AI is taking over, Mark.
Otto didn't like it when I asked him some questions about you last time. He took a little umbrage at the Otto father's offense, which I thought that was kind of funny. As we are also joined this week on the old guest seat by a newcomer to the program, if not to the network, even though he hasn't been on the network in quite some time. He is Rob Hocking, the global head of product innovation over there at the Cboe. Rob, welcome to the Advisors Option program.
Hey, how's it going? Thanks for having me today.
And Rob, it's been a while since you've been on the network. Obviously, a lot of new listeners have come on the network and certainly a different audience here on the Advisors Option. So let's start, as we do with all of our first-timers, give our audience a bit of an overview of your background in the world of options and derivatives, as well as what the heck the global head of product innovation does all the time at Cboe.
Sure. No, thanks. I spent my entire life in options. I started as a market maker on the floor of the Cboe, worked for a small company called Hull Trading that was later bought by Goldman Sachs. So I spent about 10 years at Goldman Sachs as an index vol arb trader. Moved on from there to run global volatility trading for a large prop firm in Chicago called DRW. Once again, trading on the floor, traded in the VIX, the FPX, the OEX to date myself. And then about 5 years ago, I ended up at Cboe as the head of product innovation. So what does that mean? Basically, we are the group that creates all of Cboe's new tradable products. So think we got a few coming out that I know we'll talk about later, but launching Tuesday, Thursdays, expanding our complex and FPX. Just a lot of the new tradable product comes out of the global derivatives group, and within our global derivatives group are kind of the mad scientists known as Cboe Labs, and I run that group.
I like that image, the mad scientist just cackling with lab coats and throwing
Exactly.
Vicks into a beaker and it explodes. That's a good image. I like that. By the way, I didn't think you were old enough to trade the O. The O even predates me. I think it probably maybe even predates Matt. How much time did you spend in the OEX?
A couple of years.
Wow.
It would have been 2000 was when I was standing in the middle of the OEX.
You must have been the last guy out there. Did you turn off the lights?
Exactly.
All right, so 3 for 3 former market makers on the show. Been a while since we had that, listeners. Should be fun as we keep on rolling right on into the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, listeners, a lot going on in the markets since our last episode. Of course, this is the segment that was born of the pandemic because we found ourselves pretty much month after month spending a lot of time at the top of the show saying, what the hell just happened? Because every month there was something unprecedented. And that seems to be the case again this month, listeners. A lot popping off since our last episode. Of course, we had a little bit of a sell-off, a little bit of a downturn. You probably heard about it right now, this whole thing being labeled and laid at the feet of the unwind of the carry trade over there in Japan. Either way, markets spiraled south over the weekend into the open on Monday, August 5th. And of course, we saw one of Rob's babies, VIX Cash, skyrocketing to levels we haven't seen in quite some time, hit somewhere around 65 now. That's obviously a bit of a misnomer because it didn't really print there intraday. It was more of kind of a pre-opening thing, but we'll let Rob get more into that in a second. He is one of the mad scientists over there, after all, throwing VIX into the beakers. But a lot of fun out there. Vol skyrocketing north and then plummeting back to earth in record fashion. I mean, maybe Rob can speak to this more, but as far as I'm aware, this is the fastest retracement we've ever seen in the history of volatility, where it shot north to levels it kissed pretty much back in the big sell-offs of 2020, and we haven't really seen much since, and then retraced itself not quite as fast, but pretty darn close. So a lot going on. Of course, the market's selling off and then immediately hitting the gas and effectively being green almost every session since. So a lot going on in the market since our last show. Rob, as our guest, I will give you pride of place to start off, sir. As I mentioned, you're in that little mad scientist room, messing around with all sorts of fun. Let's start with one of your babies, VIX and VIX Cash. It obviously had a wild ride this past month. Walk us through what you saw out there, some of the highs and lows, and what were your thoughts as all of this was unfolding?
Yeah, I mean, clearly what felt like a very quick liquidity event. As you just pointed out, markets are back to pretty much where they started. I think we're looking at a sub 16 VIX today as we speak. But yeah, I mean, you look at over the weekend, you look at the August 2nd sell-off that we saw in the market. And then what really, I think, precipitated the 65 VIX level, like you highlighted, was that overnight move in, call it the Asia markets. You saw Japan drop 12, almost 12.5%. As you talked about the carry trade unwind. What I like to throw out there is that was the worst one-day drop since Black Monday in '87 in Japan. So crazy kind of move that you saw. Definitely flowed through to the rest of the markets. You see China down, Hong Kong down about 2%, India 3%, Australia 3.5%. And I think what you saw and why that VIX spiked the way it did was just that much uncertainty. Quotes went very wide in the SPX and the GTH session. We were looking at, people quoting, some people backed out of the market, some went wide, just kind of preparing for what is Monday morning? What are we going to open up to? What should we be watching? And then, right before the open, you saw yet another huge dive in the E-minis. At that point, I think they were down close to 4.5%. And it took a minute for the market to stabilize. So hence the pop in VIX, hence the what I'd call the uncertainty in the market that was coming through from the options prices. But as you mentioned, we're back to pretty much where we were. Some of the hot topics now, you go back to the correlation topic. Correlations are just all-time lows, hit a low in July. We talk about, and what we've been looking at is kind of that Mag 7 effect. While, 7 main stocks are really driving the returns of the index, the rest of the constituents, have been moving a lot more independently. And when you think of low vol environments, this is really in contrast to, call it 2017, whereas you had that low environment there, you had 3-month correlation average probably around, I think it was close to 30%. And now in 2024, it's another low vol environment, but yet correlation is down around 15%. So almost half of what we saw in 2017. So I think there's a lot of, markets watching on how to prepare for moments like the election that's coming up in a few weeks, call it a few months' time. How do we take into all of this account with rates? Now looks like we're going to get our first cut in a while. A lot of macroeconomic uncertainty, and people are using options, and people are watching things like the VIX to better understand timing of those moves.
All this talk of correlation between the different assets sounds like a guy who might have a dispersion product in the offing here, Rob. I don't. Maybe you're tinkering with that in the mad scientist lab out there. I just want to throw that out there. But you mentioned something I just kind of want to hit on really quickly, because as we say many times here on the network, especially when it comes to the world of vol, the devil is very much in the details. That's why I kind of called out that 65 print in VIX cash as being maybe perhaps a little bit misleading, because it wasn't like we were trading there for a while intraday. It really was pretty much pre-open. Why don't you just walk us through that really quickly in terms of how that works, the mechanics of VIX, things widen out, and then of course you have to take the midpoint, and that could sometimes lead to these elevated prints we see, Rob.
That's right. The VIX cash is not a tradable number, as you point out. I think the front month future got to around the 40 range to give you an idea of kind of the difference between the cash and the future. Future is obviously something that is tradable in pre-market. So yeah, VIX cash markets, the VIX is determined by using SPX options bid and ask. And if there's lack of a trade, you're taking a midpoint price. When those markets go really wide, obviously, due to a lot of the uncertainty, like I talked about, it can have a driving effect on that VIX level. And so that's what we saw. We saw a lot of uncertainty in that pre-market. We saw market makers' quotes massively widen out, some of the widest quotes that we've seen. And with that came the uncertainty and kind of the increased value in the VIX. But once again, I think the futures are a better way to anchor, because that's an actual tradable number. That's where people are committing capital to. Whereas the VIX cash is just kind of, that 30-day moment in time taken as an extraction of the SPX options bid and ask.
All right, so a lot to unpack there, listeners. Let's to clarify that, because I know a lot of people are hanging their hats on this 65 number, and it really wasn't something you could go in and really, really sink your teeth into. I think the front future got up to around 37, 38. So if you're looking at tradable levels, that's still obviously very high, very elevated, but not quite to the 65 number you might have seen bandied about out there. Mr. Matt, same question for you. Obviously a lot going on since the last time you and I chatted here on the program. Vol moving all over the place, markets doing the same, carry trades being unwound, dogs and cats living together, mass hysteria. What caught your eye, sir?
let's see, the components and the regular SPY comparison. And yeah, that jumped up. It's usually hovering around 50. So we do a weighted average of the SPY component implied volatilities, and then we do that ratio over the SPY constant maturity 30-day 50 delta. And that's usually about 50. It did on August 5th, it got up to almost 80. So that was the peak, and then it's just been downhill since then across the 10 moving average, about mid-August, and it's been down ever since. And that usually is good for bullish people in the market. So as vol comes down, usually the market's just kind of riding that upwards. So that was a big thing. And you know me, Mark, I love to watch our meme indicators, which is the IWM average of the 5 delta calls. So, and what that relationship is to like the 75 delta put or something. So that the way out of the money calls, and it's just hilarious to see that it's like the euphoria in the market. Like that's my euphoria measurement. So it was, and it caught the trend. In July, after the rally, it started really falling, and then boom, right at the August, early August is when it hit bottom, and then it's been up ever since. Not quite back up to levels that we saw before that kind of mini crash, Japanese inspired mini crash, and volatility for that matter isn't back down to levels. So we still have some worry in the market. There's still some people that are gun shy after that move, but that's what I'm mainly seeing. The euphoria just was sucked out of the market, and it's slowly coming back, but at more normal levels. There's a little bit more worry in the market, which is actually usually somewhat pretty good for markets. Mark, that's what I'm saying.
Matt, I thought of you just this past week. We were on our Volatility Views program, and we profiled what I know you like a little bit of some, to put it charitably, some junk, some garbage calls in VIX every now and then. I think we saw the mother of all garbage VIX trades last week. We first noticed someone buying 5,000 of the Jan 180 calls. I think they were for about a dime. That in and of itself was just another level. But then as we dug further, we saw it was actually part of a ratio stupid. They also bought 3,000 of the Jan pars, the Jan 100, for 20 cents. So they bought the Jan par 180 ratio stupid 3,000 by 5,000 times. So I saw that and immediately thought of you. And I said, Matt, well, what are your thoughts on what is perhaps the greatest garbage VIX call trade I have ever seen, sir? And I use greatest in air quotes.
Well, I love those, Mark. So, and by the way, I always have my garbage that I load up on when it falls low. So I let them almost all go those few days. So like I think quintupled. But I'm only buying them at 20 cents. I'm selling them over $1. So I love that trade. Like I always say, it doesn't have to go up there. It just has to get near it, and those things really explode, Mark.
So we have a new back test for Otto. It's the ratio par 180 Jan stupid in VIX. We have to go back test that and see how that performs. Speaking of performance, it's time to get to a little bit of the tricks of the trade.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, listeners, welcome to the Tricks of the Trade. This is the segment on the show where we dive into, as the name implies, the way pros like to do it here in the world of options. And we don't typically on this show get into the nitty-gritty, the nuances of margin and tax treatment, because, quite frankly, it isn't the sexiest of topics. But I know specifically for this audience and for the advisors out there, many of them are tax front and center, first and foremost. And we do get a lot of tax questions on this program on a fairly regular basis. And the other side of that is, of course, margin and how margin is treated and how much capital you will actually be able to use freely in your account. I regularly refer to this as the plumbing of the option space. Not always the sexiest thing, but when it's not working, you definitely miss it. You definitely want to know more about it. So we're going to dive into that today. Rob, let's kick things off as our guest today. You folks over there at Cboe, always working with the regulators, always advocating for different things out there. One of the things that was recently approved is this new Margin Enhancement Rule for quote-unquote protected options. So tell our listeners, what are we talking about and what does that mean for them?
Absolutely. Thanks for this. I think to define protected options and kind of what we're thinking about and why we went in to get this margin relief is first to look at the concept of covered call writing. So obviously where you take, you own the underlying stock or ETF. Let's use SPY as an example. You sell an upside call against your long position. You kind of give away that portion of upside potential gain in return for collecting that premium up front against your long stock position. So very common strategy. I'm sure many of your listeners are using it. It's why so many defined outcome ETFs are hitting the market that are kind of wrapping this strategy into the ETF. So protected options, it provides margin relief when writing or selling a cash settled index call option versus a long position in the ETF that tracks the same reference index. So if I go back to our SPY example, instead of selling a SPY call against your SPY long stock, you can now sell a mini SPX call, or a symbol XSP, and call it a lookalike index option, lookalike ETF index option against your long stock and receive margin offset relief. And so for the listeners, like, why is this important? Why are we excited about this? Well, there's a number of benefits to selling index options over their ETF counterparts. And so what are those? Well, one, they're European exercise, which eliminates the risk of any early assignment on that physical delivered option. American style option. Second, there's, as you mentioned, Mark, there's potential tax benefits to trading index options. One is capital gains on ETF options, such as SPY, are taxed as ordinary income, which, those rates vary from 10 to 37%, depending on what tax bracket you're in. But index options may be eligible for more favorable tax treatment. It's under a section I'm sure everybody will look up after this. Super interesting, of the IRS tax code. It's 1256, where capital gains are taxed at a 60% long-term rate versus a 40% short-term rate on positions that are held for even less than a year. So with long-term capital gains rates ranging from, call it, 0 to 20%, or short-term rates at 10 to 37%, utilizing index options in this manner can be obviously let you keep more of your trading profits. And so lastly, and I end with this one, it's also another kind of in a way tax benefit. Index options are cash settled, which pairs really nice with an overwriting strategy. Because if your options are called away, and if they're physically settled like in SPY, ETF options, your stock gets called away, which can trigger a taxable event, depending on where your basis is and where you're holding that stock. But with cash-settled options, when they expire into cash, and so your stock is never at risk of being called away, thus you never trigger a potential taxable event in your underlying position. So a lot of the benefits of why we kind of went in to get this offset or this margin relief in place. Since regulatory approval, Cboe is now working with a lot of market participants on the implementation of this new benefit. So the rule's in place, but can I actually get this benefit where I hold my trading account? And so firms need to build this new offset into their margin system so that they recognize which ETFs are eligible in relation to which underlying index option. And so the two can be paired together. And additionally, the firm policies, procedures, all of that have to be updated, along with potential enhancements to order entry tools and so forth. So we're working with the market right now to get this implementation in place. But if this is something, obviously, that you think you would benefit from, that your clients would benefit from, please be vocal with us and with the platforms that you trade on so that, we can get this in place and it's, able to be used by you.
And I could see some of our listeners right now saying, this sounds great. I want to take advantage of all those things you're talking about, but maybe SPX a little bit intimidating, maybe a little bit of a mouthful for them to bite off. They don't need all of that notional value for their clients. We should point out this works also with the 1/10 size, the XSP as well.
Yeah, that's right. XSP, it's probably the perfect match. That's what you should look at for SPY. Both are the same exact size and would work interchangeably.
Yeah, people always forget sometimes on this show that they don't have to go the full bore SPX. There are more nuanced, dare I say it, bite-sized options that you could use that might line up with your client's needs a little bit better. Matt, as I was saying earlier, it's the plumbing of the options business, margin and taxes. Again, not the sexiest thing, but at the end of the day, anyone who's been trading options for a while knows that these two things can really come back to either bite your returns or dramatically enhance them. What are your thoughts on some of these tweaks to how options are treated, sir, from a margin and indeed a tax perspective?
I love this new thing. I trade a lot of XSP, SPX. And XSP has actually gotten a lot more liquid. So we measure market widths, and it's doing a lot better. So that a lot more people are trading in there. So that's great to see. I have my short straddle, long straddle strategy that I run in there quite a bit. So I'm enjoying the liquidity, and of course the tax treatment. Mark, I don't know if I've admitted it on this show, but I am a CPA, and I used to do some tax for Coopers and Lybrand down in the Loop, and I did all of the like Chicago research and trading. So I had the finance background before I was a market maker. I did that, so I admit it, and so now I will go read that part of the tax code, Ron. So don't threaten me with a good time.
We won't hold your CPA status against you, sir, here on the show. But I think you made a good point, Rob, about the cash settled side. And again, it's all the plumbing, so we don't get into it too often on this program, listeners. But the notion of cash settled, I know for a lot of our audience, especially the advisors, you're right, Rob. A lot of them are maybe sitting on some gains in their clients' accounts. They don't want to have that taxable event where if they write a covered call that is physically settled against it, all of a sudden their underlying is called away, and now they have a taxable event that maybe they didn't plan on, or maybe they just didn't want. With the cash settled side, it does give you that flexibility, which again is an important thing for a lot of the advisors, and we don't bring it up that often here on the show. So I'm glad you pointed that out for our listeners, Rob.
Yeah, it's a great benefit. It's like, as an exchange employee, I can't give investment advice, but I can say personally, like I love overwriting. I think it's a great way to enhance returns in my portfolio. And at the same point, I like owning the stocks that I have. And so I don't necessarily want to see them called away, but I like trying to augment and add an extra yield onto the portfolio. And this is a great way to do it.
It does seem like the pendulum in the derivatives world, everything is trendy. And for a while there, everything was swinging maybe towards some physically settled. People were saying this is great, especially when we started the onset of these new crypto derivatives that were coming online. Everyone wanted physically settled, and now the pendulum is swinging right back to cash settled, even in the crypto world, where people just like the simplicity of it at the end of the day. And there is a value in that at the end of the day, listeners, as we keep on rolling to explore the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everyone, welcome to the Earnings Volatility Report, another segment that was born of the pandemic because especially in those days, it was fascinating to watch just how little the world cared about earnings volatility. Just none of it mattered, and that was a fascinating contrast. Of course, Matt's been crunching a lot of that data for us for a number of years. So that was a big surprise. And now fast forward to today and the modern era. And spoiler alert, people care. People care a lot these days about earnings volatility. In fact, our last cycle was the highest we've had on record in terms of our long-term average. Our long-term average is now up to 113%. That's going back for the last 3 years for 12 quarters, even though we've been tracking this data much longer than that. That is the highest long-term average we've ever had. This season started out pretty hot. Every name was outperforming, listeners. It's cooled off a little bit now. And I say a little bit because we are still at right around our long-term average. The season is hanging out at 112%. Our long-term average right now is 113%. Of course, we spiked earlier this season up to some ridiculous number I don't think we've ever seen before, somewhere around 135%. It was a crazy time to be trading earnings volatility. So, Mr. Matt, when you're not talking to me, I know when you're not buying crazy garbage ratio stupids in the VIX, you're out there crunching a lot of earnings data. What's catching your eye out there in yet another explosive cycle, sir?
This is a very important report for anyone trading earnings season. What we see very consistently is when the volatility of the market levels are high, the returns from the straddles don't match what the market expects. So what that means is if you're buying straddles, you probably want to wait for the vol of the entire market to come down. And that's what we've seen that beautifully in this earnings season report, Mark. We were going along, like you said, low volatility. Whenever you see low volatility, kind of boring markets, the earnings season and the earnings straddles are usually profitable. And that's what we saw. But then, the fourth week that started on July 12th, right around that big busy week where the market fell out of bed, the returns on the straddles were extremely poor. And that's what we always see, and that's what we continue to see. So this market season has shown all of the tips that we usually talk about in one season. So this is a really important season. And, like we've been watching it for years now, when the volatility is low and the market's kind of boring, people really look at earnings, and you often get extended moves in stocks, which is obviously good for the holders of the straddles. As far as, where we are, we're in week 6, and that's kind of our last week. We had BMO come out. That was the biggest mover, down about 6%. Today, they only were expecting 3.1%. The big news, we got quoted all over. The Globe and Mail covered us. The Market Watch covered ORAT's data. But NVIDIA is always the big one. And NVIDIA is coming out with earnings. And let's pull them up right now in the ORAT's dashboard. Of course, the ORAT's dashboard, orats.com. You can see all this, but the average implied move 7.7 in NVIDIA. Mark, it's 10. So they're expecting a 10% move in an NVIDIA $128 stock. So big move. The average actuals is 8.1. NVIDIA looks like it's beat 1, 2, 3, 4 of 12. So we'll see what's going on. But that's definitely our most followed earnings is NVIDIA, and that's basically what is going on in the earnings this season. Really paying attention, you could learn a lot with what's going on, Mark.
Funny you should mention the NVIDIA earnings data, because we also used it yesterday, your earnings data, for our question of the week. It's live right now, listeners. You can go play along at Options on your device of choice. We said essentially what Matt just said. NVIDIA earnings coming up this Wednesday. NVIDIA options at the time, we used dollar amounts. It's easy for people to wrap their heads around those. It was pricing in right around $12.75 heading into the announcement. The average earnings move they've had over the past 12 quarters has been right around $10.50. So obviously pricing in a wee bit more juice. We thought we'd ask you folks, is that too pricey, too cheap, or just about right? Mr. Matt, since it's your data, I'll let you go first. What do you think? And then B, more importantly, where do you think our audience is falling right now?
I'm going to say too pricey, and I think your audience is going to say too pricey, just based on our historical data. Again, with the rule of thumb, with the overall market levels, it's a little bit elevated, so that would lead to too pricey as well. So that's what I'm leaning towards, Mark.
I thought our audience would lean that way as well, and actually surprising, 47.1%. So leading the poll right now, Matt, saying it sounds about right to them. They like that. They like paying 12 3/4 for a straddle going out in a few days out here. So there you go, listeners. Everything old is new again. Obviously, it goes till Wednesday. The vote can change. In fact, just in the last few hours, Too Pricey has jumped up to about 39.2%. About Right was well north of 50% just yesterday. So obviously, more people are starting to come in and say, maybe that looks a little bit pricey. But we'll see. Too Cheap right now saying you want to pay more, 13.7%. Not surprising. That is coming in at number 3 out there. But this obviously goes out tomorrow. Get over there at Options. It should still be live when this podcast goes live, listeners. If you're listening live right now, of course, you can always go vote over there at Options. Rob, I won't make you vote on the NVIDIA straddle, but you were talking earlier about correlation between the index and its component parts. I was only half joking before. You are obviously working on a dispersion product over there. So that certainly, I think, for a lot of people, casts the whole notion of earnings season and earnings volatility in a very different light, especially when you're trying to compare it to what's going on the index front. So when you're not talking to us, obviously you're over there in the mad scientist lab working on that dispersion product. What are your thoughts on what we're seeing out there from an earnings vol perspective? And also going back to your earlier point about correlation, how things are correlating versus index vol these days, sir?
Yeah, obviously the dispersion product, the index we launched, I think it was October of last year. It's called DSPX, and it really tracks effectively the VIX against the basket of names that we have that is about, call it the top 90 names, and individual market cap weighted VIXs on those against the VIX itself. So looking at the equity vol versus the index, and as you can see from DSPX, dispersion is incredibly high, correlation low, dispersion high. Hence, like we talked about, with the call it 7 mega names that are leading the charge, and the remaining names all having somewhat low correlation between their returns. I think it's an interesting trade. Obviously, we hear a lot of demand that people are trading dispersion, hence why they were asking for a product to be developed. And so we're excited to hopefully get a tradable version of the future out probably the tail half of next year. But something we're closely looking at. We've heard a lot of positive feedback on using the DSPX index to track, that relationship. And we're excited to try to make it tradable.
You got everyone excited with that press release last year, Rob. You dangled a tradable dispersion product in front of us. Now we have to wait till next year. I see what you're doing. You got everyone hyped, and now we have to cool our jets a little bit. At least we have a date.
It's true. It's true. I can even, in my defense, we actually want to make, and why it's taking so long, I'm happy to tell the audience, we're trying to make the settlement tradable. As the VIX settlement is tradable, there's an auction that you go in, trade the SPX options for the settlement of VIX. We're trying to make this settlement tradable as well. As you can imagine, baskets of options and call it 90 names versus the basket of SPX options all trading together is a bit of a financial engineering feat that the mad scientists are working hard on in the lab, but it is taking a little bit of time to put that level of engineering through.
All right, listeners. So if you saw that release last year and you were excited, you were hyped, might have thought you can get your hot little hands on tradable dispersion this year. Doesn't sound like it, but hopefully in the second half of next year. But if you want to get hyped about some other things, let's see what we can find for you, listeners, as we roll right on into The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we break down all of the big option stories that maybe you didn't get a chance to hear about because you're busy doing your actual job, dealing with your clients, answering that phone when it rings, because that is job number one at the end of the day. Luckily for you, we're here for you here on the Advisor's Option. And one of the ongoing stories we've been discussing on this show ever really since the onset of the pandemic has been this just incredible resurgence in options volume. And there's been many factors attributed to that. Of course, the explosion of interest in retail early on in the pandemic. Everyone was home and everyone was trading, so that was a very different scenario as well. We saw volume continue to shoot up, and it has pretty much shot up month over month and year over year ever since 2020. There was some concern. Earlier this year, we saw the first couple of chinks in that armor. We saw March was a down year over year. Of course, a bit of an aberration there, but still a down year over year. There also, we saw, I do believe June was another down month. So we've seen a couple this year, which got some people thinking maybe we have plateaued. Maybe the growth is finally starting to slow. And then lo and behold, we have a month like July come in, which again, July, not seasonally the most explosive month from the options volume calendar, listeners. Usually this time of summer, people are off in the Hamptons or in the south of France. They're not slinging options. And yet this year, quite a different tale was told looking at the numbers from our friends over there at OCC for last month. And again, we're only a few days away from the August numbers as well. And I'm guessing, given what happened around August 5th, should be an interesting number this month as well. But last month, we also saw some, shall we say, turbulence in the market, and that led to a lot of volume. Overall options volume cleared at OCC up 25.4% from the year before. That's a huge jump. Obviously, again, it's versus July, so a small baseline, but still, huge jump. 32.6% if you break it down for index futures, which is, again, our index options, I should say, which is right in Rob's wheelhouse. A 34% increase for ETF options. And even the futures, again, getting back to Rob's wheelhouse. VIX futures up 38% year over year. So just an explosive month. And again, so far, aside from a couple of hiccups, a very explosive year. And it seems like so far, anecdotally, August is going to be in for the same fate. Rob, again, when you're not talking to us and messing around with the lab, you're obviously keeping a firm eye on the volume numbers. What are your thoughts on this explosive volume trend we've seen, particularly over the last few years post-pandemic, and the little bit of consternation, the little bit of fear we saw trickle in this year when we saw a few down months in March and June, Rob, versus last month, which was just explosive by any definition?
Yeah, I think, we tend to look at the longer term trends at the exchange level. I'm super excited to see, the growth in options over the last few years. I think it makes sense as a lifelong options user. That whole concept of defining your outcome, defining your risk, I think makes complete sense. And so we continue to see investors use options to position, very actively around all the macroeconomic uncertainty. The VIX complex, has been super popular, as you mentioned, as a hedge against, tail risks, uncertainties like the upcoming U.S. election. For reference, the VIX index jumped over 10 points in the month leading up to the last two U.S. elections. So are we in for some more volatility? Not sure, but history says yes. And because of this, VIX option volumes are on pace for, as you mentioned, another record year. ADV surged in the second quarter with 18% quarter over quarter increases to just almost 850,000 option contracts a day. It was the third largest quarter on record for us. And so we see blips like you mentioned on August 2nd, where VIX options traded 3.4 million contracts on the day. Obviously, a lot of people repositioning around, what they felt like was bad economic data. And then we saw obviously what happened over the weekend and into August 5th. We also have seen strong demand for hedging with VIX put options in particular. In the immediate aftermath of the recent spike, we've seen the put call ratio jump near 1 year high in that sense. So people now turning to put options in VIX, not just the call options that we've previously seen more dominantly traded. On the SPX front, solid volumes across the suite. With second quarter ADV increased 9% year over year. Average, call it around 3 million option contracts. Again, if you look at those days around August 2nd, August 5th, I think we were around almost 4.5 million option contracts that traded on those days in SPX. And we're still seeing a mix. I know a lot of people track 0DTE and that real short dated front end curve option. And we're still seeing a mix, even with option increases, we're still seeing a mix of that 45 to just under 50% of the volume showing up in that same day trading around, and people just positioning around market uncertainty on the shorter end of the curve. But the demand for SPX options also continues to extend beyond the U.S. investors. We're seeing engagement from Europe, APAC, investors in both regular trading hours and big increases in global trading hours, albeit they're still a pretty small percentage of our overall volume. We're still seeing a lot of overnight trading starting to happen. And that's being driven off, new partnerships with global brokers such as Futu Hong Kong, Weibo Thailand, Samsung Futures. So a lot of people are starting to come in from overseas that want to trade in these products. And so it's an exciting time. I think option volumes will continue to grow. And of course, at Cboe, we're very excited about that.
You mentioned the 0 day. That's obviously been the phenomenon that everyone's rushed to over the past few years. But we all kept saying, we haven't really seen a real test of the markets in this new 0 DTE environment. Well, we saw that on August 5th. Markets sold off pretty hard. Obviously, we talked about what happened with VIX earlier in the show. There's been a lot of talk about how the percentage of SPX volume that day, that was 0 DTE, fell off quite a bit. I think it was somewhere around the low 20% range as opposed to the roughly 50% it is now. But outside of that, it seems like things actually functioned to a surprising degree. What are your thoughts on how the 0 day options in particular performed, and also maybe not surprising that they fell to a lower percentage, but everything still held up. The market didn't implode in our first real test of the downside in the 0 DTE era, Rob.
That's right. And we were very, very pleased by that. All of our systems held up, 100% uptime, no blips, no problems. So we're excited to see that. Obviously, with the growth, it can tax systems, but yet we've been able to evolve and grow our systems to be able to handle adding capacity as the options market has grown. So that was super exciting for us. Just overall, I think, the percentage lowering with regards to a move like we saw in the 0 DTE relative to the rest of the complex, we've seen that with other kind of moves to the downside where that percentage kind of drops a little bit in 0 DTE. I think this made sense. A lot of people were pointing to more of a global, call it repricing of risk, or a shift where we saw all of the markets across kind of the globe with, I mentioned APAC and whatnot, sell off. And so with that, I think you saw people positioning in the SPX complex in that mid to longer term range to anticipate kind of a shift in regime. So made sense to us. But yeah, all in all, no issues from a systems perspective, from a trading perspective, and of course, OCC had no issues from a clearing perspective.
So there we go, listeners. The gamma bombs did not explode on August 5th. Are they still waiting? I guess we'll find out. But so far, we survived the first real test. Mr. Matt, you and I have been talking about options volume and the trends therein for some time. July, I think, by any definition, was just a banger month out there. What are your thoughts on a pretty much 25% increase across the board in options last month, sir?
Yeah, it's been pretty incredible. And what I noticed, I have my opinion on 0 DTE, and we haven't been shy about talking about it. Basically that the 0 DTEs are helping the market by reducing volatility, and it's doing that. And you could see it in our slope figures, our put call slope, so that how high the put implied volatility is versus the call implied volatility. The puts have really come down relatively to the calls, and I attribute most of that to the 0 DTE, how much liquidity there is, how much trading there is going on, and the balanced trades happening in the 0 DTEs. And this, we're all market makers. This allows market makers to hedge out their kind of traditional ongoing risk of being short puts and long calls, as people do call overwriting, as Ron was talking about earlier, and buy puts to hedge their long stock positions. And so the market makers are usually, and especially before 0 DTEs came out, they are stuck with short puts. So they'll often jack up the implied volatility of the puts to try to entice people to sell it to them. But ever since 0 DTEs came out, we've seen the slope go way down. Well, the interesting thing is on August 5th, as the 0 DTEers kind of sat on their hands and there wasn't nearly the liquidity, the market makers pounded up the put call relationship, so that puts were really high in implied volatility, as they tried to get get more puts as the market went down. So that's what I'm seeing. I think a lot of this is driven by zero DTEs, a lot of it by things that you're doing and the Cboe is doing and we're doing out there, educating, making better technology, and there's more people trading. As Ron said, we're definitely at ORAT seeing a lot more people come in overseas, and so that's interesting and exciting to see. But all of this is leading to just more and more volume out there, Mark.
Speaking of the volume, before we get off this, Rob, you brought up a point I kind of wanted to hit on a little bit, because it really was brought up to me very strenuously down at the OIC conference a few months ago when I was talking to all the exchanges and brokers and trading firms out there, just what an impact on volume all these defined income ETFs are having out there right now. You touched on it earlier when we were in the Tricks of the Trade segment about some of the use cases that is going on out there for these different strategies and the margin and tax treatment they're in. But it does seem like they are changing the game as well from a volume perspective. For example, when I was down at OIC, all the exchanges were talking to me very excitedly about Flex, not a topic I thought would be hot and heavy in the year 2024, but it's because so many of these defined outcome ETFs are using options to achieve those outcomes. And as you mentioned earlier, we were talking about the settlement. They want to get away from the exercise risk, so they are using Flex to get the European exercise and just pretty much swap away the exercise risk. So Flex volumes are exploding. Just one offshoot of this explosion of defined outcome ETFs. But I'm curious your thoughts on this rapidly growing sector and the impact they're having. We've all been talking here on this show and everywhere else about the rise of retail, but maybe we should also be talking about the rise of these defined outcome ETFs, Rob.
Yeah, I think you bring up a great point. One, we love to see the growth in that market segment. But, when you think about it, options to new investors sometimes can be scary. You hear of leverage, you hear, wow, you can have massive losses and quick moves, things like that. And so people that want and are edging, easing into, call it that options market, can use some of these defined outcome ETFs as taking that underlying position, overwriting an option on it. Now you're getting the benefits of owning the option, but it's all bundled into a nice ETF that you can stick in your trading account. So to me, it's kind of a step easing into more sophisticated options usage, and you're trusting an index or an ETF creator to be able to do that for you. So I love the growth there. I love seeing it. I think it's going to continue, because this idea of defining your outcome is not one, to me, that's going to slow down. It's just a better investment approach. So something we're really excited about. Also on the Flex front, like you mentioned, Flex is great. It's been around for a long time, but I think, as you point out, as people are starting to use options in their portfolio, a lot of times you need kind of a bespoke piece of risk, whether you want the exact at the money, not the closest to in the standardized listed options market, or you want the exact, 110% call or the exact 90% put. Now you can use things like Flex to get that, the European settlement, cash settlement, or European style cash settlement, and introduce them and put them into your ETFs or portfolios where you're defining that outcome with a little bit more bespoke nature of using Flex. So two great things, and I continue to expect to see the growth continue to build there.
Matt, I know you're like me. You're more of a kind of a build your own, do it yourself kind of guy when it comes to options utilization. For a lot of the advisors and certainly the funds out there, that's not really an option. A pun intended. So what are your thoughts out there on this explosion of volume coming out of these defined ETFs that are using options, and as a result, the impact this is having on the overall options market going forward?
Yeah, I mean, it's great that they're getting more exposure out there, but I always get nervous with these ETFs and ETNs that have to do a certain thing, because market participants are very smart and they could front run certain things, especially if they are having to buy when the market's going down, sell when the market's going down, or buy when it's going up. So I get a little nervous. I don't have much of an opinion other than just that feeling that I get, Mark.
All right, everybody, that music means we've come to the end of another journey through the world of advisors and options. Man, time flies when we're having fun. But we have a little bit of time here at the end of the show, Rob. Before we go, you kind of hinted at the start of the show When you're not talking to us, you're there with your lab coat and the mad scientists over there at Cboe. I do like that, the Cboe Labs. It conjures up all sorts of interesting mental images out there. But give our listeners a little bit of a peek behind the door. What are you folks cooking up over there at Cboe Labs they can get excited about?
Sure, thanks, Mark. We've been super busy. Obviously, you've seen in the last couple of years, we've been focused on new indices. I always kind of think of the market in three different ways. We got to identify opportunities. We got to provide, as an exchange, we got to provide access to those opportunities, and then the right products to be able to trade those opportunities. So from the identify part, we've obviously been very active on the index front. So think, one-day VIX, which we launched a while back, the DSPX, which we've already covered today and talked about. The other one that I'd like to highlight is VIX TLT. This really provides investors visibility into the U.S. Treasury market volatility world. And by using our VIX methodology and overlaying it on the TLT ETF, the 20-year Treasury ETF, we're providing an apples-to-apples comparison for those tracking the relationship between U.S. Treasury and U.S. equity market volatility, something that's been very active. And as obviously the rates world picks up, and now we're looking at Powell and cuts coming up, something to keep your eye on. On the tradable product front, we're excited about two upcoming product launches. One is the Cboe S&P 500 variance futures. And then secondly is introducing options that will settle directly into VIX futures. Both we feel will knock down access barriers for investors and give them additional risk management tools heading into what's historically been a more volatile election season. And the second thing, because we've highlighted a lot of zero DTE and short dated trading, that's one big piece to the options on VIX futures is the way VIX options are structured now, the security options. We're limited in how we can list them due to how we settle them with the auctions that I mentioned earlier. With options that settle into the future, we'll be able to settle them on a daily basis as part of our end-of-day VIX futures settlement. And with settling them on a daily basis, we'll be able to introduce dailies that settle into VIX futures, so dailies on VIX. Something that we're excited about and something that's all purely driven off customer demand. This is where the market's telling us to go, so that's what we're building.
Dailies on VIX. You're getting me excited here, Rob, and a little bit nervous, but that's kind of the fun of a new product out there as well. And if folks want to check out all this cool stuff you and the team are working on, where should they go? What should they do?
Reach out to Cboe, go to our website. We have a lot of resource hubs out there on all these new products that we're going to introduce. Cboe.com.
There we go, listeners. Easy to find. You know where to find them. Cboe.com is the place to go. And Mr. Matt, what do you have up your sleeve with your new favorite buddy, your rogue AI, Mr. Otto, sir?
Can we get a drum roll, Mark?
We got the other music going now, but maybe I'll see if I can have him cut in a drum roll after the fact, sir.
Gene, can you get a drum roll? We are introducing live data to our dashboard and Interactive Brokers. So now if you're at Interactive Brokers or any broker, you could trade on the dashboard, but we connect and see your positions at Interactive Brokers, Tradier, TradeStation. So it's getting incredible. It's been a long time coming. And we're very excited for it, and our clients are super excited. We're going in a few days, Mark. We'll be up and running, which is crazy. So we're very excited.
IB and live data, dude. Sounds like a good combo, sir. And yeah. Where should folks go if they want to kick the tires on all that fun, sir?
Yeah, orats.com. You can email me, matt@orats.com. So all over there. It's a great new website. Otto's there. Ask Otto a question.
Yes, ask Otto a question, especially about Matt. It's his responses are always fun. Check it out for yourselves, listeners. A brand new dashboard. I was just playing around with it not too long ago. Be careful, though. Once you go over there, you're going to get sucked down a rabbit hole. It's a good rabbit hole, but it's going to suck you in nonetheless. Orats.com, ORATS.com, the place to go to kick the tires and light the fires. And last but not least, don't forget our friends over there at OIC, optionseducation.org, the place to go to check out all their latest data and research and education and all the fun they have cooking over there. That's going to do it for us on the network today. A short day. The producers have pity on my voice today, listeners. Back again tomorrow for, of course, a little bit of options boot camp fun. Back again on Thursday for our usual doubleheader, kicking things off with the option block, where I'll be joined by our pal, the Flow Master from the Cboe, as well as other special guests. After that, This Week in Futures Options with our friends over there at CME. Friday, Vol Views, talking all things volatility. Who's going to join us in the guest seat? Got to tune in to find out. And then one more time, after Volatility Views, exclusively for our pro members, we come back to talk about all the crazy trades that caught our attention this week on Options Oddities. You want to check that out for yourselves? Only one place to go. TheOptionsInsider.com/pro is the place to go to learn more. Then, of course, we're back again next week, all the way into next month, and another episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the Cboe over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.